More economic data for the Fed to digest as it concludes its two-day meeting on interest rates. Consumer prices rising 0.4% in November, in line with expectations. This follows yesterday's greater than expected rise in producer prices, and housing starts increasing less than expected, 8.9, building permits up 6%. So as the Fed concludes its two-day meeting on interest rates, should they be concerned about inflation or not? Steve Ricchiuto is chief economist at Mizuho Securities USA. We also have Shari Olefson, real estate attorney at Fowler, White & Boggs, and CNBC's Steve Leisman with us as well. Guys, I'm going to send it around the horn. Steve, I'll start with you. Steve Ricchiuto, what do you think? Should they be worried about inflation, deflation, neither?
Deflation is a little bit greater risk, I believe, on the table for them than the actual inflation numbers. Yeah, when you look at the service components of inflation over the past 4 years, you've been seeing a very, very decided move down in the service components inflation. We're now down running at an annual rate of less than 0.7%. And that's the very, very long-term trend where inflation is going. The dollar's affected some of the tradable goods prices at the core level. Yeah. But without that, we've been seeing a marked deceleration in the overall level of inflation. And given the excess capacity in the system, that's going to be with us for quite some time. You've got to worry whether we can move further down.
We're going around the horn. Shari, what do you think?
You know, from a real estate perspective, Melissa, the obvious threat is inflation. I mean, there are three things that are keeping this slope as slippery as they are. We've got foreclosure rates, we've got unemployment, and we've got inflation affecting mortgage interest rates. And the difference between mortgage interest rates and the other two issues is that mortgage interest rates will affect everyone. Foreclosures only affect you if you're part of that group. Same thing with unemployment. But interest rates will create a damper on the housing market and some serious issues for home sales.
Steve Leisman, take your first whack at it.
Well, you know, I want to pick up on the math of what Steve Ricchiuto was just talking about, which is that, Steve, am I right about 60% of the CPI is services, right?
Correct.
Of which 40% of the core is just housing costs. So the math is such that it's going to be very difficult for anything that's going on out there, for example, in the commodity price world, to really drive the bottom line consumer price number.
Here comes, go ahead.
Look,
here comes Larry. Here comes Larry.
Inflation is not selected prices rising, or for that matter, falling. Inflation is too much money chasing too few goods. The Fed has pumped up its balance sheet. I dare say, Shari, you win the Nobel Prize for economics because there are nascent inflation pressures. And look, all items CPI, 3.4% at an annual rate for the past 3 months. And you know what, Shari? 1.8% over the last 12 months. In other words, we are now seeing the beginnings of a year-on-year turn up in the inflation rate. And I want to ask you, should the Fed keep its zero interest rate free money policy for an extended period, Shari? That's going to be the big question at 2:15 p.m. today.
Extended period, I don't think so. Today, yes, I do think so. But going into 2010, we're already starting to see absorption levels. And Larry, if you look at a 30-year perspective, in particular on new home starts, which came out today, but any of the real estate indicators, we are just now reaching the bottom of the valleys from the prior cycles, meaning that we're really getting into territory we've been in before. Up until now, this has been uncharted territories for home builders, for consumers, for banks.
But if I'm not mistaken, that means continued declines in what they call owner's equivalent rent. It's still going to be cheap to go out there and rent a house or an apartment, so that will continue to drive down the aggregate price level, to use Larry's term.
But you got to look at this. In the aggregate, the whole index is rising on a 12-month change and a 3-month change. And, Steve, that's why I disagree with you. You can selectively pinpoint areas, but
you're saying I'm being selective in my data, Larry? Let me just tell you what's going to...
You are being selective.
I'm not.
Actually, I was aiming this at Steve Ricchiuto.
Okay, go ahead.
I just want to say that when you look at the monetary bulge that the Fed has created, you've got to ask yourself, how long will we even stay at 1 or 2%? And will inflation drift up to 2 to 3%? And with housing starts and yesterday industrial production and earlier, Friday, retail sales, the Fed is operating an emergency policy, Steve. I don't think we have an emergency anymore. And that's my question to you. Why are they in an emergency when the rest of the data don't show it? Is the Fed wrong, Steve? Is that possible?
No. I think that the answer is very, very simple. I think a lot of people are assuming we don't have an emergency situation anymore. And I think people have wrongly jumped to that conclusion. You know, we have a financial market that's done a little bit better. We're on the back of an enormous amount of monetary stimulus that was provided to it, and that stimulus is beginning to wane its way off. By March, the Fed stops purchasing mortgage-backed securities, and this goes right to the young lady who was talking about real estate a minute ago, because once the Federal Reserve stops buying mortgage-backed securities, watch what's going to happen to mortgage rates, and it's not going to be a reflection of inflation. By the same token, what happens to regular interest rates in here may not be a function of what happens to inflation either, because the government's spending money like mad and printing debt like mad, and we're going to have supply pressures pushing up interest rates, not inflation.
Okay, before we go, I just want to ask who has it right. I mean, Time Magazine has Ben Bernanke as the man of the year. At the same time, we're hearing that the Senate Confirmation Committee is going to put off their decision for another month. Both sides there. Who's got it right?
Kiss of death.
Yeah, what do you think? Steve, I'll start with you. Steve Leisman, who's got it right? Man of the year, or we can't even decide if we're going to keep this guy around, we're going to put it off for another month?
I think it can be both, Melissa. If you look at what our polling data showed about Bernanke, half the country of the people who know of him, half approve, half disapprove, and 53% don't know. So I think the Senate's reflecting that ambivalence out there.
Shari, go ahead.
And I think Time Magazine reflecting a point of view that he did save the country.
Do you know
Wait, Melissa, our president preemptively won the Nobel Peace Prize, so I don't see anything wrong with giving the man of the year preemptively.
Do you know, by the way, as we go around, the Rasmussen poll, 20% favor his reconfirmation. 40% are against his reconfirmation.
One of the things I think you guys have to keep in mind here before we end this thing, I'd like to get my 2 cents in here. I think, you know, we have a danger when we begin to make people like Chairman of the Federal Reserve, quote unquote, rock stars like we did to Alan Greenspan. And I think putting them on the front page of Time Magazine, trying to make them a household word and make them bigger than they are, I think is a big fundamental policy mistake.
All right, we're going to leave it there, guys. Thanks to all three of you for joining us. We appreciate it.